Hello everybody, welcome to the March 3rd through 4th, Monday and Tuesday price action review. So getting started, we are looking at the S&P on the left and the Nasdaq on the right on the hourly time frame. And as you guys know, on Sunday, I said that I would have liked to see these highs get drawn towards for the S&P and the Nasdaq. And as you can see, price did not deliver what we expected. He got it wrong. Yes, I said in the past that I'm going to get it wrong sometimes. Nothing is ever 100% in trading, and a 100% strategy does not exist. And there will be times in the future where you get it wrong yourself, but the main importance is taking a step back, understanding why you got it wrong, and learning from the experience. So looking at the weekly time frame now, incorporating the Dow, so we have the S&P on the left, Nasdaq in the middle, and the Dow on the right. We have that weekly TPD right there with this candle right here. And I wanted to see this be used to support price higher momentarily as a retracement from the SMT that we had at this low right here. As you can see, the Nasdaq had already taken out this low while the S&P had created a failure swing on this low. So I wanted to see this right here act as a retracement right here, running into those highs that I had outlined on Sunday. Now going from the weekly time frame to the daily time frame, while still keeping this TPD in mind. As you can see on the S&P, we fell just short of these highs being delivered, while on the Nasdaq, we traded into this wick right here, and on the Dow, we traded above the previous week's high, creating a monthly cycle sequential SMT, which is what drove us lower. Now, looking at the benefit of hindsight, what I truly wanted to see was the S&P run out this high right here, serving that retracement, and then continuation lower, which is what we saw Monday and Tuesday, while the Nasdaq would have created a failure swing. And I didn't really take into account the Dow, just because, as you guys know, I tell you that the Dow is low probability, and cracks and correlations that form between the Nasdaq and the S&P are a higher probability. But if we take into account the same logic behind reversion levels and apply that to continuation TPDs, which is what you guys learned over the weekend, you can also apply that same logic with the reversion levels to continuation TPDs. So this TPD right here, viewing it through the daily time frame, was that weekly candle being candle 2. As you can see, the highest up close candle in the S&P and the Nasdaq is where price really traded into before continuing. So continuation TPDs can also have reversion levels in them as well, used for continuations. And if you guys remember, before we had this shift or this downside delivery that you guys have been seeing for the past couple of weeks, you guys know before we created that real last run, which was right here, on the Nasdaq I marked out a 4-hour wick, price traded into that and then traded higher, while on the S&P it traded below this low. That was the same logic that I applied that I'm now sharing with you. So as you can see, the S&P traded into the actual opening price of that reversion level, while the Nasdaq just traded into a wick, or into the wick. And this in and of itself, as you guys know already, is another form of Kraken correlation. While the Dow actually created the stop run, making the SMT, making the reversion level fully valid, which is why price dropped. But even though we have all of this in the benefit of hindsight, and even if we would have identified this, price is still in a low probability condition. As you guys can see, even after we created that Kraken correlation, the S&P traded inside of the reversion level, while the Nasdaq traded into the wick. There was really nothing here at the height of the run to give confirmation for the downside. There was a small non-sequential SMT right here, but as you guys know, that's low probability, but that's the main thing tipping its hand that caused price to run down after trading inside of this reversion level. But another thing tipping its hand that was telling you price is likely to be difficult to navigate is, as we can see, we're now incorporating DXY, being the US dollar index, comparing that to the S&P. We can see that the dollar is moving directly in correlation with the S&P. So the dollar in the S&P, or the futures triad as in a whole, is moving the same direction as the dollar. Whenever you see this, this is indicative of very low probability price action. And on top of that, on Monday, I believe, we had President Trump speaking more on tariffs. So that was another real world news event or something happening in the real world that can influence price and pretty much just wipe out any analysis you had in mind. Which now, with all the things going on around the world, that isn't an uncommon thing to happen anymore. But as we can see, still the same principle holds. The US dollar is trading in the same direction as the S&P. So that's why it was pretty difficult to navigate, and why some things that you might have seen in price didn't hold that same level of precision as they usually do, on top of it being a non-farm payroll week. So now, where do I expect price to draw from here? Personally, I don't hold an opinion to one side. Now, gun to my head, due to this daily time frame TPD, I would like to see price expand higher, especially on the NASDAQ running this buy side liquidity. But again, price action is very 50-50. Don't take my word for it. Don't take my word as the gospel. Really, anything could happen right now. We just need to wait for non-farm payroll to release. And then week 2 of the month should become a lot cleaner and a lot clearer as far as direction wise. So for right now, we just have a range high and a range low, and we're waiting for price to attack either side of the range to give us insight. So hopefully you all found this one insightful. I will speak with you all again tomorrow. Good luck and good trading.